Welcome to the Nadex Application and Strategy webinar series presented by Daryl Martin with ApexInvesting.com. Today we're going to talk about which spread to choose for which strategy. And the two things that you need to know about this is understanding how time and distance to the floor or ceiling impacts the spread's price in order to help you pick the ideal spread for your trading strategy. In addition, you want to understand the four categories of box spreads to easily identify which spread to choose for your trading strategy. In order to do this, we're going to have a few different topics. We're going to talk about a quick overview of strategy examples using Nadex spreads. I'm going to explain the spread cost as it relates to what's called intrinsic versus extrinsic value in order to help you understand the effect of time and distance to the floor or ceiling on the spread's price. I'm going to go over the four categories of spreads that you need to understand. Then we're going to define and look at examples of each category. We're going to look at the advantages and disadvantages of each category and the strategies that they can be used on. We're also going to look at an overview of the categories on the Nadex platform, and then we're going to do a summary comparison of the advantages and disadvantages to wrap it all up and make it really simple for you. All right, so let's do a quick overview of some basic strategy examples. You could buy a spread or be long the spread because you think the market's going to go up and having the goal of minimum risk and a large profit potential. You could also sell or short a spread with the idea of having minimum risk and large profit potential. You could hedge with the spreads, and that's where you combine the underlying market with the spread to help hedge your risk. You can scalp, that's where you're going in for very small, quick moves. You can go for what's called a gap fill, so when the market gaps down from the close yesterday and then moves back in the cash market hours and goes back up to fill in the price. You also could go and do a news trade for quick, fast moves on government news announcements. You can do swing trading, trading the oscillations in the market. You could do trend trading, where you're trying to really ride a strong trend and maximize it. And you can also do neutral trading. That's where you expect the market to be flat, or maybe you expect it to move in one direction, but not move too much in another direction. And if any of those three happen, then you can profit on a neutral trade. And so these are all of the different strategies that you can do, and there's even more than this, but this is a quick summary for you just to get your creative juices flowing and to help you understand that you really want to figure out what's the best spread for the strategy that you want to do, and that's what we're going to be talking about in this video. Part of understanding the best spread is understanding just the spread's price. Where does it come from, and how is it affected? And when you're looking at the cost of a spread, the risk capital that you have to put up, there's two factors. And these are really big words, but they're really basic. And I'm going to explain them to you, then I'm actually going to show you an example of it and break it down, okay? So we have intrinsic value, which is the real value in the spread, the actual underlying market real value that exists in the spread. And then you have what's called the extrinsic value, the time value, okay? And that's added into the spread's price. Well, there'll be more extrinsic value, meaning a more expensive spread, the closer to the spread is to the floor or the ceiling, all right? And the longer the spread is from expiration, it'll have more extrinsic value. It'll have less extrinsic value if it's really close to the middle in between the floor and the ceiling. And then the closer it is to expiration, the less extrinsic value there is. And so I'm going to go over a lot of examples on this, so if you don't get it yet, that's okay. Just stay with me and I'll take you through each step, okay? Extrinsic value is the premium added to the spread to reflect the time left in the spread. And this is in addition to any, if any, real intrinsic value. All right, so let's take a look at what I mean by intrinsic versus extrinsic value. So what we're assuming right here on this spread is that the S&P, when these spreads were quoted, was at 1372.25. All right, and there is a common denominator between all of these spreads. They all have the exact same ceiling. So on the left side you have the floor, on the right side you have the ceiling. So 1375, 1375, and 1375. All right. Another factor happening in this spread is this one expires at 1 o'clock, this one expires at 2 o'clock, and this one expires at 4:15. And again, that's 1 p.m. Eastern Time, 2 p.m. Eastern Time, and 4:15 p.m. Eastern Time. All right? So we're selling them. They all have the exact same ceiling, but the risk is different. This one has a risk of 31, this one has a risk of 38, and this one has a risk of 45. So what you can immediately notice is the difference, okay? So an additional hour, there's $7 of what you would call extrinsic value or premium between this one and this one. At 38 to 45, there's an additional $7 in extrinsic value, okay? Now what about intrinsic value? What is intrinsic value? Well, intrinsic value is really just the ceiling, which is, again, $13.75 on all of them, minus where the underlying market is trading. So $13.75 minus where the S&P E-mini futures is trading at the time of these quotes, $13.7225. So if you subtract that, you get 2.75, which equals $27.50 in real value, meaning the S&P actually has that value. If it expired right there, then you would still keep $27.50. You would lose the extrinsic value if it expired at $13.7225. But you have real value of $27.50 in this spread. And again, a quick summary, that's simply the ceiling minus where it's trading. Now, if we were buying, it would be where it's trading minus the floor. On the extrinsic value, how do we figure that out? What we do is we take where is it trading. So in this case, since we're selling, $13.7225 for the market is trading at, minus the bid price, the sell price, which is right here, $13.71.9. Okay, so when we subtract those, we get 0.35, which will be $3.50. On this one right here, we're subtracting where the market's trading, minus 1371.2, which is 1.05, or $10.50 in extrinsic value. And then over here, we are subtracting 1372.25 from 1370.5, which is 1.75, or $17.50. So when we add the intrinsic value, the real value, meaning where is the underlying market compared to the ceiling, plus the time value, notice how there's more time value. This one expires at 1, this one expires at 2, and again, this one expires at 4:15. Then there's more time value in it, but they all have the exact same intrinsic because they all have the exact same ceiling. So when we add those together, then we get the actual risk. So in this case, $31, and you'll notice right here, $31 in risk. And we add them together here, $38 in risk, and right here, $45 and $45 in risk. So just understand that the more time there is to expiration, the more premium there will be in the spread, if the spread is closer to the floor or ceiling. Alright, so with all that, it sounds really complicated. The reality is you don't have to understand and do that on every trade at all. Okay? What you do need to understand is a very simple concept. The longer it is until the spread expires, the more extrinsic value will be in the spread. Okay, now one other thing also affects the extrinsic value. So we have time until expiration. We also have distance to the floor or the ceiling. And to try to make this simple, I broke it down to 4 categories. Okay, so I'm going to walk through each category with you. I'm going to show you an example of it. We're going to do a summary and put it all together. The 4 categories are what's called out of the money, at the money, in the money, and then deep in the money or beyond the money. So beyond the money is when it's so deep in the money you can't even get a quote. Okay? Out of the money is when you're buying a spread and the underlying market is below the floor. Okay? So if you're buying it and the market is below the floor of the spread. Out of the money on selling is when you sell a spread and the underlying market is above the ceiling. So the quote of the underlying market is above the ceiling. The advantages of out of the money spreads, or OTM spreads, is they have a very low risk. The risk is defined like on all the spreads. But when they have a large move, then you have a lot of profit potential. Okay? The disadvantage is a large move is required, and that to really even break even on the trade. And that can outweigh the really low risk. And a lot of people hop in because they see a $5 risk, not realizing it has to move 10 points to be profitable. And if you do want to do an out-of-the-money spread, you might even want to compare it to the binaries to see if an out-of-the-money or a binary trade is better for the move that you're expecting. So here's a quick example of oil, which at the time of these spreads quotes was quoting at $90.09. Okay, these spreads are both out of the money because the ceiling on these two spreads is 90. Okay, and the floor is 88.50. So with that being said, with again $90.09 is obviously greater than $90. Then you have a very low risk, only $13 on this spread that expires at 1 and $22 on this spread that expires at 2. However, to break even on this trade, oil will have to move from $90.09 down to $89.87 before you're at break even. On this trade, oil will have to move again from $90.09 down to $89.78 before you're at break even. After that point, then your $22 or your $13 risk is covered, and now you have room for the existing profit potential as it keeps to move down all the way down to the floor, which is $88.50. Alright, so let's check out the trade comparing one of the spreads that we just looked at to a binary. So oil currently trading at $90.01 at the time of these quotes, and putting them side by side, they both expire at the exact same time at 2:30, and obviously you're expecting oil to move below $89.50 because on the spread itself you're selling it at $89.38. So if you're selling at $89.38, you expect it to at least get to that price, if not lower. Okay? So with that, you would have a very large profit potential. Okay? You'd have a $24 risk and a $576 profit potential on the spread. On the binary, with the $24 risk, you would have a $76 profit potential. Now, the profit potential is not near as high on the binary as it is on the spread. But if oil literally just gets down to $89.50, you will make $76. If oil gets down to $89.50 on the spread, you'll actually lose your $24 of extrinsic value. If it gets down to $89.38, you'll keep your $24 because it will become intrinsic value. And as it goes lower, you'll be able to make up to $576 if it moved all the way down to $86.50. So depending upon the move that you're expecting, when you're looking at it out of the money spread, compare it to your profit potential and the move that you actually expect to see which one may be more profitable for you. All right, so now let's look at the money spread. So this is where you're buying a spread where the underlying is very close to the floor, or when you're selling a spread where the underlying is very close to the ceiling. The advantages of at-the-money spreads are that they are a low risk and a high reward whether you're buying or selling them. They're often the trade of choice because of this really low risk. And they have less movement required than an out-of-the-money spread to be at break-even and get to profit. And the extrinsic value or premium gets lower as you get closer to expiration. They're good for swing and trend trading. They're good for gap-fill trades. They're great for hedging in combinations with the underlying market, and they're great for straddle trades as well. The disadvantage to at-the-money spreads is they do have more risk than an out-of-the-money spread, and generally there's more of a move required for them to be break-even than on an in-the-money spread. And then the extrinsic value, of course, will be higher at the start of the trading time. All right, and here's an example of an oil futures contract. Oil is at $90.05, and these two spreads are at the money because we're buying them, and oil is very close to the floor. Remember, on the sell, it's close to the ceiling. On the buy, it's close to the floor for at the money. So the floor on these spreads is $90. Oil's at $90.05. And so the one that expires at 1 o'clock has a risk of $18 and a profit potential of $132, whereas the one that expires at 2 o'clock has an additional $8 of extrinsic value risk in there. So it has a risk of $26 and a profit potential of $124. And by expiration, to be at break even, oil would have to be at $90.18 for the one that expires at 1, and it'd have to be at $90.26 for the one that expires at 2, because that's where you're buying the spread. So you're expecting that oil is at least going to be at or above $90.18. Now, you won't lose all of that. If it expires at $90.10, then you'll still have $10 of your $18 of risk given back to you. And that really is a fundamental element that separates the spreads from the binaries, as it doesn't have to hit a certain strike price for it to be an all or nothing. It's not an all or nothing. It's a variable payout depending upon where it expires in between the floor and the ceiling. All right, so now let's check out the in-the-money spreads, and that's simply buying a spread or selling a spread where the underlying is basically right near the middle in between the floor and the ceiling. So basically like a risk reward of 1 to 1. So a $50 risk to a $50 reward, or maybe a $40 risk to a $60 reward, but not a $60 risk to a $40 reward. So you need 1 to 1 or better. Meaning for every dollar risk, you need to at least have a dollar profit potential for it to be an in-the-money spread. And there's a lot of advantages to in-the-money spreads. If you're wanting to mirror the underlying market and not really deal with the extrinsic value when you're getting into the trade, then in-the-money spreads are perfect for you. There's very little movement required for them to be at break-even because they're going to be right at where the market is. They also can easily have a lower margin requirement than the outright. So let's say you're putting up $500 to day trade the S&P E-minis. You may only have to put up, say, $250 to do a very similar trade using the in-the-money spreads, which are trading at the same or near the same level as the S&P E-minis. So less money is required for margin, and you have defined risk, which you would not have on an outright futures trade. Again, they have little to no extrinsic value or premium built into them, and they're really ideal for scalpers because there's very little movement required. They're great for swing and trend trading, and they're good for gap fill trading as well. The one disadvantage is they do have a larger risk than the at-the-money and out-of-the-money spreads. So it's all about what strategy you're looking to do to pick the right spread for you. But if your strategy is, I want to mirror the underlying as closely as possible, have defined risk, use less money that wouldn't be required on, say, a day trade using the futures contract, and not have a big move required in order to be at break-even, then that's where I'd want to go for an in-the-money spread. All right, so now let's look at an example of an in-the-money spread. And you'll notice something right off the bat here, okay? So whether you're looking to buy or sell, that it's right near where oil's at. So oil, the market of oil right now is trading at $90.10. That's the oil futures contract at the time of these spreads. And you can buy the 1 o'clock one at $90.12 or sell it at $90.07. You can buy the 2 o'clock expiration one at $90.11 or sell it at $90.06. And that's with a pretty equal risk reward. So on this one you have a risk of $68 to $69 there, and a reward of $81 to $82, depending upon which spread you choose. And again, at the money, so that way there's very, very little time value you're dealing with, and oil doesn't have to move much at all for you to be at break even, and then potentially profit. And that's why this is perfect for scalp traders or those who are trying to mirror the underlying market. All right, so now we have the last category, the deep in the money or the beyond the money spreads. So that's buying a spread where the underlying is above the ceiling, or selling a spread where the underlying is below the floor. Now, beyond the money is when a spread is so deep in the money that you literally don't even see a quote. There's really only one possible advantage to deep in the money or beyond the money spreads, and that's where you're trying to collect the extrinsic value premium if the market does not go back in the money. But if you're doing this, it's going to be a very high risk, very low reward trade, and therefore there's really very little reason to trade it. The whole point of Nadex is to define your risk, have limited risk, and good reward. And you're basically going to have to hold it to expiration to really be able to close it out at a profit. And if your goal is to collect premium, you may be a lot better off doing a binary to collect the premium. And here's really just a quick example of an oil future, two spreads. So oil trading at 90.07, and if you're looking to buy a binary, again, this is where the oil is above the ceiling when you're buying or below the floor when you're selling. Really not a good reason to do the trade at all. And you can tell that the ceiling being at $90 and oil being at 90.07, that your profit potential on the trade, basically the extrinsic value there, is $13. That's collecting that premium, assuming that oil doesn't drop below 89.91 before expiration. If it does, again, you're looking at a loss there. And the loss potential on the trade is $137. So a very bad risk-reward ratio. If you go over and you look at the one that expires a little bit later, you can make $22. But you have a risk of $128. Again, so here's an example of looking at an oil trade that expires at 2, a binary that's expiring at 2:30, and basically what you're assuming, of course, is that oil is going to stay above $90. That's why you would actually buy this spread. So what would happen if you went and bought a binary that said, I think oil is going to stay above $90? Well, your profit on the trade would only be $44.50, but that's double the profit on the spread trade, and your loss would be capped at $55.50 if it did close below 90. Whereas your loss could be as high as $128 on the spread trade. So again, deep in the money options, probably not the best trading strategy. If you're wanting to collect premium, check out the binaries for that. All right, so now let's do a quick overview and put all this together for you. So you're on the Nadex platform, you click on US 500, you click on the 1 o'clock expiration spreads, and you're trying to figure out which one you want to do, okay? So the in the money spread, if the S&P 500 is currently trading at 1370.75, then the in-the-money spread is the first spread right here, because 1370.75 is trading right in the middle of the floor and the ceiling. So whether you want to buy it or sell it, this would be your in-the-money spread. If the strategy you want to do is best with in-the-money, such as scalping, or just wanting to mirror the underlying market, then that would be the spread that you would want to choose. This spread right here, if selling it, would be an at-the-money spread, because since the S&P is currently at 1370.75 and the ceiling is at 1370, you're very close to the ceiling, so you're going to have a very low risk and a very high profit potential on the trade. However, if you're buying it, it'd be a deep in-the-money spread, because 1370.75 is above the ceiling on the trade. And then this last spread over here would be an out-of-the-money spread if you're selling it, Because the S&P 500 is above the ceiling. And if you're wanting to buy the spread, it would be deep in the money. It actually would be beyond the money, because the S&P 500 is not only above the price, but you can't even get a quote to buy it. That's why it's beyond the money. All right, so now let's do a quick wrap-up comparison of the out of the money, the at the money, the in the money, and the deep in the money spreads. So on the out of the money, they have a very low risk and a high reward potential, and they have defined risk like all the spreads do. And they're great when a large move is expected, but at the same time, a large move is required, and you might be better with the binary than an out of the money, so make sure you check and compare the two. And that's the same with the deep in the money. Except for they're going to have a really high risk, a very low reward. There's very little reason to trade them. You definitely want to check them against the binary before you even consider doing a deep in the money spread. And at the money spread, low risk, high reward, often the trade of choice. There's less movement required usually than an out of the money spread, and the extrinsic value will get less and less as you get closer to expiration. They're great for swing and trend trading. They're good for gap fill trades. They're good for hedging in combination with underlying markets. They're great for straddle trades, and they may have a little more risk than out of the money, and they may have a little more movement required than in the money, but at the same time, they have a great risk-reward ratio with very little move required. Now, in the money can be ideal for those who are tempted to mirror the market, and they want very little movement required to break even, and you can trade it with less margin usually than an outright contract, depending upon what spread you choose. And defined risk like the other spreads, they have, again, little to no extrinsic value built in. They're ideal for scalpers, they're good for swing and trend trading, and they're also good for gap-filled trades. They will have a larger dollar risk than both your at-the-money and your out-of-the-money spreads. So that's a quick summary. Just to give you an idea, get your creative juices flowing. If you have questions, let us know. And, if you want to open a live or demo account, simply go to nadex.com today, okay? It's only $100 to fund a live account and get a demo account for free. Also, make sure to visit us at apexinvesting.com to learn more about how to trade Nadex and for any questions you have on this video or any of our other videos.